Okay, now let's talk about some hedging. A couple different types. We can delineate them starting off by calling them static versus dynamic hedges. A static hedge is held to expiration. A dynamic hedge is adjusted along the way. All right, so here's an example. A US-based manager must hedge 5 million euros of assets for 3 months. 1-month contracts and 3-month contracts are available. 1 month after the initiation of the hedge, the assets are worth 4.5 million euros. Okay, approach 1. Sell 5 million euros forward for 1 month. When the contract expires, sell 4.5 million euros forward. Okay, so what's going on there basically is a strategy where we start with the 1 month forward, and then at the end of that 1 month when that contract expires, we see what the assets are worth again. Now the assets are worth 4.5 million, where they started out at 5 million. And so now that means, well, the hedge needs to be smaller than going forward. So we adjust every time a contract expires. We come up with a new hedge that again matches the new notional amount that we're trying to hedge, in this case, 4.5 million euros. Now, let's say we're rolling the hedge here, okay? So we've come to the end of that first 1 month contract. And so now what happens is that the manager would then want to execute a foreign exchange swap. So they basically want to exchange contracts to roll the hedge forward. In other words, continue it after the expiration of that first month's contract. So, because they sold 5 million euros forward, at the end of that first month, the first thing they're going to need to do 2 days before that contract expires is have an offsetting trade. In other words, they want to buy 5 million euros. So that offsets the initial forward sale. And so they want to do that 2 days before the contract expires because settlement is T plus 2. There's 2 business days to settle these trades. So then once that's done and that hedge for the first month has now been offset, well then now they initiate the new hedge. Assets are now worth 4.5 million after the first month. So now they want to sell 4.5 million euros forward. And so that's the new leg of the new hedge. So there will be a cash flow gain if the euro has decreased in value during that period of time. There'll be a cash outflow or a cash loss if the euro has increased in value during that period of time. So static versus dynamic hedging. Now let's look at a dynamic hedge example. So we begin, we've got $5 million euros worth of assets. We sell 5 million euros forward for the full 3 months. Okay. Now, it doesn't mean that we ignore the hedge for the entire 3 months. At the end of that first month, what do we see? Again, the assets have fallen in value from 5 million euros down to 4.5 million euros. So what do? We don't need as big a hedge anymore. So we had sold 5 million forward. Now we're going to buy back 500,000 forward for the remaining 2 months. So what that does is that it adjusts our hedge down from the initial value of being 5 million short to now just being 4.5 million short. Again, we're matching up with the notional value of the assets. So if we've done this with a 3-month contract at the beginning of that 3-month period, and then a month later we do it with a 2-month contract, well, still no cash flow is going on because both of those contracts are still going to expire at the end of the 3 months. Now, the third approach is to do just an entirely static hedge. You sell 5 million euros forward for 3 months and don't do anything about it. As the asset values change over that 3-month period of time, you don't adjust it. So you say, okay, this hedge is going to have a mismatch to it as the assets change in value, but you say, okay, it's probably going to be a fairly modest change in asset values over those 3 months, and so you don't bother changing the hedge. And again, since you're doing this with a 3-month contract over a 3-month period of time, no cash flows until the contract expires. Okay, now if we want to decide between static versus dynamic hedging, well, it's going to sort of depend upon our level of risk aversion. Think of it that way. So if I have shorter term contracts and I have a dynamic hedge where I'm making several trades over a period of time, well, that does improve the hedge results. So if I'm a little bit more risk averse, I don't want to see my hedge get mismatched, well, I may be more interested in being a bit more dynamic in my hedging, but notice that that's also probably going to increase the cost as well. If I'm rolling over shorter term contracts, well, that's going to create interim cash flows. Again, in our 3-month example, if I'm using contracts that expire every month, well, then I'm going to have a cash flow at month 1, either inflow or outflow. Same thing maybe the next month, again, inflow or outflow, and then also at the end of the 3rd month. So there are going to be some interim cash flows there that we're going to have to keep our eye on. Again, higher risk aversion suggests more frequent rebalancing. We don't want the notional value of the assets to get too far away from the value of our hedge. We want to rebalance that hedge and again, match up those notional values. lower risk aversion and perhaps stronger manager views. Perhaps the manager says, okay, well, actually, yeah, we've got a bit of a hedge on here, but I actually think this currency is going to move in our favor. So maybe we'll let the hedge get a little bit mismatched in terms of notional value. And so in that case, maybe we're a little bit more discretionary about the hedging. We don't have a fully locked in hedge. We still allow some room for currency movements to hopefully play in our favor. Okay, now, if I have contracts that are coming to expiration, I'm then rolling over into subsequent contracts, okay, then we're going to have something called a roll yield or a roll return, okay? Now, the equation here is perfectly accurate, but it may not necessarily be that illuminating. So the equation here is that we're going to take the change in the forward values, FT minus F0, minus the change in the spot price, ST minus S0, all right? So convergence dictates, remember, with forwards, with futures, at expiration, the forward price and the spot price have to converge to the same point. If the contract is held to expiration, the roll yield and the percentage roll yield are going to be what? It's going to be the difference between the spot price and the forward price at time zero. That's going to be the roll yield in dollar terms. In percentage terms, we take that number or take that term and divide it by S0. That's going to give us that percentage. Okay. Let me just give you a quick example, which you might want to just jot down here. I'll sort of jot it down here. Okay. So let's say our futures price for a particular contract is $1.05 USD per Swiss franc. Okay, let's say the current spot price, $1.04. Okay, so let's say you decide to go long at the spot at time zero. So basically you are buying Swiss francs for a price of $1.04 US. Let's say you're a US trader in this example, okay? So then you also sell the forward, okay? So you commit today that at the end of the period, you will sell Swiss francs and receive a price of $1.05 US, okay? So if I can buy them in the spot market today for $1.04 per franc, and I'm selling them in the future for $1.05 per franc, well then I'm going to calculate, or I'm going to generate a roll yield, okay? That roll yield is going to be what? I'm going to gain basically 1 penny on that transaction over that period. So that's going to be my roll yield. And if I do this in percentage terms, I'm going to divide that by $1.04. So that's an example of what a roll yield is. Basically, if there is a forward premium, well, then my roll yield should be positive. If it's a forward discount, then my roll yield typically will be negative. So roll yield can be considered a cost of hedging, as hedging locks in that differential between the spot price and the forward price. Okay, so let's continue on with this example here. So roll yield and hedging costs. Okay, so like in my prior example, what we have on the slide here is that there is a forward premium. So right now the forward price is greater than the spot price. So the forward price curve is upward sloping, all right? Let's also say that the interest rate of the price security, IP, is greater than the interest rate of the base security, IB, okay? So if I have a short forward position in the base currency, that's going to earn me a positive roll yield. So that's like the example that I just wrote on the screen on the last slide here. So that's going to decrease my hedging costs and encourage hedging, because what did we do? We bought the spot, but we shorted the futures, all right? So we had that short forward or futures position in the base currency, right? So I sold Swiss francs forward in my example. And so I sold them at $1.05 forward, bought them at the spot market at $1.04 today. And so I'm going to earn a positive roll yield. That's going to decrease my hedging costs, and it will encourage hedging, right? If I can make a little money in the deal, hey, it makes it a little bit better for me. If I have a long forward position, well, obviously that's going to be the opposite case. I'm going to have a negative roll yield. That's going to increase my hedging costs and at the margin discourage me from hedging at least a little bit. All right, now, what if we have a forward discount? Okay, so the forward price is less than the spot price. The forward price curve is downward sloping. Let's say interest rate of the price currency is less than the interest rate of the base currency, all right? Now everything flips, right? So if I have a short forward position in the base, now that's going to earn me a negative roll yield, increase my hedging costs, make me less likely to hedge. Long forward position in the base earns a positive roll yield, decreases the hedging costs, and encourages hedging. Now, you can either just commit that to memory, right? See how A leads to B to C to D. Or you can think of my example, right? Think of those numbers. Basically, put some numbers in your mind where you have a spot price, a forward price. That transaction gave me a positive roll yield when there was a forward premium. Okay, so then you say, all right, well then if I have the opposite, then that's going to cost me money, right? So that's going to discourage me from hedging. Whatever it does to put that in your mind, whether it's rote memorization, what's even better typically is that if you can think of an example in your mind where you can put the numbers to it and sort of work through that example quickly in your mind. Best case scenario is that this just becomes intuitive. You work through enough problems, practice these slides, practice the examples enough times, you can look at a set of numbers and say, yeah, I'm going to have a negative roll yield, I'm going to have a positive roll yield. That should be our goal here. However, trying to optimize sort of your time on this with the sense that you want to at least be able to replicate this correctly, obviously, on the exam. So whether that means you need to sit down and quickly write through a quick example to remind yourself, or you've gotten it to that intuitive level, whatever it takes. Okay, so just a broader picture here, and if you look at the little footnote at the bottom of the slide here, this applies to forwards and futures on any asset class, okay? So just to make this, widen the lens a little bit, make this a bigger picture, as time passes, remember, forward price and spot prices need to converge. FT needs to be equal to ST at contract expiration. So FT decreases in price. What does that mean? That's going to give us a negative roll return if we're long, a positive roll return if we're short, okay? Then if we're down at the bottom, those bottom two legs on our little line chart there, if FT increases in price, well, then that's going to give us a positive roll yield if we're long the forward, negative roll yield if we're short the forward. So basically looking at the changes of the futures price relative to the spot price during that period of time can also give us a sense of, are we getting a positive or a negative roll return? Again, if looking at that chart doesn't make it entirely intuitive to you, well then yes, that means you need to keep working the problems. The more numbers you put to this, these calculations all sort of flow in the same way. When you keep getting positives and negatives, then hopefully the intuition will start to stick in your mind. This is exactly going from point A to point B. Yes, I'm going to have a negative roll return, a positive roll return. Okay, now let's talk a little bit more broadly about trading strategies. If I have perfect hedging using forward contracts, remember there's no initial cost at time zero. So we're going to lock in a price at time zero, and it symmetrically modifies our risk and return. What does that mean? It means that it takes away our downside, but the opportunity cost is that it also eliminates our upside. So by comparison, if I have a put option on a currency, well, I'm going to pay some money explicitly up front because options do cost money up front, right? You have to pay that premium. However, I still keep a bit of my upside. So I'll just do a quick graph down here again, just to remind us what the payoff is of a put option, right? I have my strike price here. I have a payoff of 0, but then once that asset value or that currency value drops below the strike price, then I have an upward sloping payoff function. So what does that mean? Well, that means that if the price drops, well then, every dollar or every euro, every yen, whatever I'm losing on my long position, well, I'm going to be gaining by my put option position, so they're going to negate each other out. However, if I don't need the put option, if it turns out the currency value stays above that strike price, well, let's say the currency moves in my favor. Well, I still have that upside potential. The put option doesn't ruin that. Now, discretionary hedging, what that allows us to do is to say, okay, maybe we don't take a fully perfect hedge and lock out both sides. We leave a little bit of room, a little bit of discretion. Now, that does mean we do potentially expose ourselves a little bit more to the downside risk, but at the same time, we're reducing that opportunity cost by still leaving ourselves some upside potential. Okay, all right, so trading strategies. Option-based hedging can asymmetrically modify risk, okay? That's with options, right? Because the graph I just showed you a moment ago, or reminded you of a moment ago, you're probably well familiar with it by now. So if we buy at the money put options, okay, removes all that downside risk, retains all the upside potential, it will have the highest initial cost, all right? So that was the graph that I just drew a little bit earlier here. So, we have the value of our option, right? Has a payoff of 0 down to the strike price here, upward sloping payoff curve. If the value drops below that, so basically the money that we're losing in our long position in the currency, we're going to make up with the payoff of the put option. And so if I were to then draw my overall combined value of my protective put position, what it's going to look like is something like this. So my portfolio will never fall below this value that I have here on the y-axis. Why? Because if the value of the asset drops more, well then that's immediately counteracted by the value of my put option increasing, or the payoff of my put option increasing. So that makes me kind of even Steven. That's why that line is flat through this region here. All right. However, if the currency moves in my favor, well, then I still have the upside potential here. Okay, and so as a result, well, yeah, then if I buy an at-the-money put option, it does remove all the downside risk. That's why the combined payoff of that protective put position is flat when you combine the asset plus the put. But then I still have all of that upside potential where if things move in my favor, I can still capture that upside. Now, this also has the highest initial cost because I have to pay money up front to buy that put option. Now, one other thing I could do is I could buy out of the money put options. Now, the graph is going to look pretty much the same. It's just going to shift a little bit on the graph. And so what this means is that, this is going to be a little bit hard to replicate exactly like this. So what I would have is maybe a slightly lower value. So let me say this is just a value of X. If I have an out of the money put option, well, what I'm doing here is that I'm removing the downside risk below the lower strike price and still retaining all the upside potential. So basically, I'm going to allow the portfolio to have a slightly lower value in the worst case scenario. So let's say that's X minus delta, delta being some positive amount of money. So if we wanted to say, let's just put some numbers to this. Let's say this is 100. If I buy out of the money put options, well, those are going to be put options that have a lower strike price, and so the price can fall farther before the put option kicks in. Maybe that means that I allow the portfolio to get down to as low as a value of 95, a little bit lower than the initial value, because what am I doing? I'm buying an option that has a lower strike price. Let's say a strike price of 95, whereas this option had a strike price of 100. So it's cheaper for me to buy a put option with a strike price of 95 because the price has to drop below 95 before it kicks in. That's less likely to happen, so that means this put option is going to be cheaper. If this is put option 1 and this is put option 2, well, put option 1 is going to be greater in value than put option 2 because it goes into the money sooner. So if I buy the out of the money put option, I'm paying less because I'm paying P2 instead of P1. However, it doesn't give me as much downside protection. It does keep me from a catastrophic loss. However, my portfolio may drop a little bit more in value because the strike price on the put option is a little bit lower as well. So not quite as much downside risk protection, does still give me the upside potential, gives me a lower initial cost. Okay, another trading strategy. I buy a higher strike price and sell a lower strike price put option. So we call this a put spread, okay? So this provides the downside protection only between the two strike prices. It retains all the upside potential, okay? So again, these are still put options. Let's start with the upside potential picture of this. Put options retain all the upside potential. If the asset value increases, if the currency value increases and you don't need the put options, okay, well then you spent money on those two option premiums that you ended up not needing, but you have all that upside potential. If the value goes up, then that value comes to you. Now, how about the downside protection? Okay, so we're buying a higher strike price put and we're selling a lower strike price put, okay? So in terms of payoff here, this is just gonna be the payoff of the options here, not combined with the portfolio. Let's say I buy the higher strike price put. This is, let's say this put option has a strike price of X1, and we sell a lower strike price put option. Let's say that this has a strike price of X2, okay? So just like before, option 1 is going to be more expensive than option 2. So, or to put it another way, put option 2 is going to be less expensive than put option 1. Okay? So this is going to lower my initial cost because I'm selling an option and receiving the premium revenue from that, right? I'm selling P2, receiving that. I'm buying P1, so that's going to cost me money. And because P1 is more expensive, my position will have a net positive outflow as a result, but it will be a little less than me just buying P1 and only doing that. But because it has a lower initial cost, it's also going to give me a lower amount of protection. So the payoff from buying X1, the one with the higher strike price, I'm going to have that payoff. However, if the price drops below X2, well now X2 has a payoff that payoff's going to move against me because I sold it, right? That's going to be a downward sloping curve, okay? So what that means is that when I combine the payoff of these two together, what's the payoff going to look like? I'm going to have a zero payoff here. I'm going to have a positive payoff in this range where X1 is paying off and X2 is not paid off yet. But then if the price drops below X2 and that option now has a payoff, well, that payoff is coming out of my pocket. So every dollar that I have to pay out on X2 is negating every dollar I'm receiving for owning the put option that has a strike price of X1. And so what that means is that my payoff becomes flat. So if the price drops below X2, my protection is gone because my put options negate each other after that point. So get back to the text here. Provides downside protection only between the two strike prices. Basically, I only make money or get a positive payoff on my options between the range of X2 and X1 on those strike prices. So less protection. If I have a catastrophic loss, well, I'm going to be stuck because after a certain point, my two put options just negate each other out. Meanwhile, my assets are falling in value still. So that makes it a little bit less costly for me. I have a little bit less protection. Still, I have all the upside potential. Okay, next strategy, sell a call option and buy a put option. We call this a collar. All right, so this provides us some downside protection because we have the put option. We also retain some upside potential. However, it's going to be limited because we've sold a call option, right? If the value of the assets or the value of the currency goes up, well, then what's going to happen is, yeah, we're going to gain to a certain degree, but then once we go above that call option strike price, well, every additional bit of currency we're making money on our long position, we're going to pay it right back out to the person we sold the call option to. Okay? If these two options are equal in price, we call that a zero cost collar. And then we can also reverse these trades where we buy the call option and sell the put. Then we would call that just a reversal of the risk, a risk reversal. Now, if I graph out the payoffs, and again, I'm just going to graph the payoffs here of the option position. Okay? So what I'm going to want here is I'm going to want the strike price of the put, let me denote this as XP, to be less than the strike price of the call option. I'll call this XC. Okay? So if the value of our underlying falls below XP, then that's when our put option pays off. All right? So that's going to be our payoff line there for the put option. On the other hand, if the underlying goes up in value, okay, well, yeah, the underlying is increasing in value, that's good, but if it increases in value above the strike price of this call option, well, then that call option now becomes in the money. But the problem is we've sold that call option. So that payoff is now coming out of our pocket. So the payoff of the call option for us is going to be downward sloping and negative like that, okay? So if we think about this from this graph, then think about this in our mind of pairing this up with our portfolio, okay? So if the underlying drops in value, the put option, because of its positive payoff here, that provides us a downside protection, right? As the underlying value drops, the put option gains, they negate each other out, protects us from that downside risk. On the upside, however, if the value goes from XP to XC, well then, yeah, we've got no payoff on either of our options here. So as the underlying increases in value, we get to capture that value. However, if it keeps going up and it goes up past the price of where the strike price of the call option is, well, then our upside gets negated because above that value, the underlying gains, but at the same time, we're turning around and paying that out to the person we sold the call option to. So that negates our upside at that point. So we have a narrow range where we still retain the upside potential. It cancels out above the call option strike price. We also have the downside protection if the underlying falls below the put option strike price. Okay, last trading strategy. Buy a higher strike price, sell a lower strike price put option, plus sell an out-of-the-money call option. Okay, so this is a spread trade, and specifically this is called a seagull spread. Okay, why is it called a seagull spread? Well, you may have remembered at some point doing a butterfly spread. If you did a butterfly spread, you had a payoff that looked something like this, or it may have been like this. So if you looked at that top line that I just drew there, that sort of looks like a butterfly, right? You know, we've got the head here and the wings out to the sides here, right? That sort of looks like a butterfly, okay? Now, why is this called a seagull spread? Well, because if you graph out the payoffs, it's going to look something like this. Kind of like a butterfly, but kind of on its side, kind of how we think seagulls fly. All right, now, rather than draw this all out, you'll see a couple practice problems most likely where you can draw this out. This is a little bit more of an obscure strategy, not surprisingly. But what this does for us is that it provides downside protection between two put strike prices and also gives us some upside potential to the call strike price. And again, because we are buying some options but selling some other options, selling that out of the money call and selling that lower strike price put, again, it's going to have a lower initial cost. So a seagull spread looks like a butterfly spread, if you recall what a butterfly spread is. However, the payoff is going to look like a butterfly spread kind of tilted on its side. Okay, so some other modifications to lower the initial cost of hedging. So one thing we can do is mismatch the size of the option position. So we buy fewer puts, we sell more calls, right? So if I'm selling more call options, well, then I'm receiving more premium income or I'm receiving more premium payments than if I'm buying fewer puts, then that means a little bit less money is going out. So that lowers my initial cost, but of course that also means that I'm not getting the same amount of protection either. I can also use exotic options. We're just going to mention this here to sort of plant the seed in your mind. Knock-in or knockout options, binary options. We don't spend a lot of time talking about these things, but they are other ways that you can try and sort of cut down your cost of hedging. It does change the risk profile, right? There's no free lunch in any of this. However, if you're trying to lower your initial costs, these are positions you can take to try and do so. So hint here, focus on what each piece of the transaction does to understand the effect on initial cost. Obviously, if you're selling options, you're going to receive the premium revenue from that, versus whether you're buying options, that's premium that's going out. So if you're doing a combination of the two in whatever fashion, well, then that's going to help negate your initial cost versus just buying put options or just buying call options. But if you're cutting down that initial cost, it also means that you're somewhat mitigating the risk management that you're doing and potentially also cutting down on the upside potential.